Mark, great to see you.
Hey, Frank.
So we're just talking about it right here. Netflix up more than 20% in Q4. A lot of excitement about its ad-supported tier at first, but it seems to be getting off to a slow start. What's setting it up for a strong start in 2023?
Well, we did turn tactically constructive on the internet sector for 23 because we think multiples have been de-risked, estimates have been de-risked, and we've seen enough cost actions, kind of an unprecedented level of RIFs, reduction in force RIFs being taken across the space. I think that creates this EPS slingshot opportunity. But all that said, macro trends are deteriorating. You heard that, or decelerating. You saw that in the Department of Commerce data. We've seen that in other checks. And so you want to be tactical about it. You want to find companies that have already taken out costs, that have got a new revenue stream, or have got somewhat recession resilient revenue streams, and you want companies that have got a new product cycle. That's Netflix. So it's our top pick for the year. They've taken out costs earlier in the year. I think $9.99 or $6.99 now for Netflix's library. That's about as cheap as you can get for entertainment if we go through a recession. And then I think this advertising business is the real deal. It's off to a sluggish start, but Frank, have you seen any ads promoting this? I haven't, and I haven't seen them in the U.S., Germany, or the U.K., the three largest markets. I think they're doing it in some other markets, and I think we're going to start seeing more of it as they roll out their password sharing plans next year. So I still think it's a major catalyst. It addresses rising price sensitivity at the company, and they can do it in a way that's really positive for unit economics. So I'm sticking with Netflix. Today's move doesn't face me.
I want to stick with Netflix just for a minute. How crucial is content to this ad-supported tier? Obviously, they have big hit shows like Stranger Things, Bridgerton. How important is it for those shows to come back and keep people not only watching, but also watching the ads?
It's extremely important, Frank. The two most important reasons why people have been churning off of Netflix in the past, it used to actually be content. And then price actually became the bigger driver. That's why I thought this ad-supported initiative could be so useful in terms of helping grow subs. But content is still king here with all of the streaming companies. Netflix's advantage is now we've gone through a period of accelerating competition in streaming over the last 3 years. That all changed. I'm going to overstate it, but that all changed when Disney fired its CEO because he was generating excessive losses in their Disney Plus streaming business. We're now entering a period of streaming industry rationalization. I think that helps the incumbent, the leading incumbent. That's Netflix. They spend $17 billion a year on content hits, and you need 220 million paying subscribers to support a spend like that. Well, Netflix has that, and I think their subscriber base will continue to grow. So content is king, but I think Netflix has the P&L and the subscriber base to afford paying whatever king-like levels of content spend.
Mark, it's Kelly. Your two other top picks also jumped out at me. One of them's Uber, which has had a tough year. And the other one is Wix, which we don't talk a lot about, but it actually is also down about 50%. So Uber and Wix, if people are looking across this market today and wondering, if there's a couple of cheap stocks to pick up, why are they your top picks?
So I'll stick with those, Kelly, those three screens I use. You want to find names that have got some recession resilience. I don't cover a defensive sector. Tech is discretion. It's much more of a discretionary sector, especially on the consumer side, but even on the enterprise side, we're seeing a slowdown in cloud spend. So you want to find something that's somewhat recession resilient. I think mobility is that. I mean, you still need to commute. You'll still want the social rides to and from restaurants or homes or movies, whatever it is on the weekends. You still have your airport trips. I just don't think mobility, I think it's more of a utility than a consumer discretion item. And then Uber's also taken out costs. All of the travel and the mobility names, they had to take those 20 to 30%. It was that bad. RIFs way back in 2020, but because of COVID, that means going into next year, I think their cost bases are already matching what could be a softness in revenue. And then there's a couple of interesting product initiatives that I really have liked out of Uber, including what's called upfront pricing, which has been, I think, a huge boost for their drivers. And there's a counter-cyclical hedge, finally, to Uber. You're getting more drivers coming onto the network because they need that side hustle. And Uber is a great way for you to make an extra quick $35-40 an hour. So I like Uber. I think it's reasonably defensive. You just turned a corner on free cash flow. And if you're going to continue to generate positive free cash flow at Uber, more value investors will come in.